Imagine this scenario. You save every month in a disciplined way, believing that your balance will silently grow until it becomes something significant. But here's the detail that almost no one notices. If your savings account yields only 1% per year, your money will take about 72 years to double. 72 years. That's practically a lifetime just to multiply by 2. And while that happens, inflation waits for no one. You go shopping and discover that those same $50 that used to cover an entire week now disappear in just a few items. Nothing has changed in your effort, but everything has changed in purchasing power. Because while the number in your account grows slowly, the real value of that money, what it can actually buy, is decreasing. And that's why so many people do everything right and still remain broke. The problem isn't that your money doesn't grow. The problem is that it grows too slowly for the world you live in. You look at your account balance and think, at least it's increasing. Until one day, you realize your money isn't going as far as it used to, because the world around you is constantly in motion. Rent goes up, insurance goes up, grocery prices go up, and all of this goes up every year, even if you don't notice it in your day-to-day life. Now here's the point, almost no one calculates. If your money earns 1% per year, but the cost of living rises 4%, you are not preserving wealth. You are accepting a slow loss. It's not visible, but it's continuous. You feel responsible. You believe you're being prudent, while in practice, you're falling behind and getting poorer every year that passes. It's like running a race where the ground is tilted against you. If you don't accelerate, you slide. And most people discover this too late, when they realize that decades of saving haven't created freedom. They've only created prolonged survival, but there's a simple way to test if your money is really working. A quick mental calculation that reveals whether time is on your side or against you. And when you understand this, it becomes impossible to ignore the problem. This tool is called the Rule of 72, and it's one of the simplest and most powerful ways to understand money. It works like this. You take the number 72 and divide it by the annual rate of return. The result is the approximate number of years it takes for your money to double. Simple as that. If your investment yields 10% per year, 72 divided by 10 equals 7.2. That is, your money approximately doubles every 7 years. If it yields 6%, it takes about 12 years. If it yields 3%, it takes 24 years. And if it yields 1%, it takes a lifetime. This simple number transforms something invisible into something concrete. It shows how small differences in return completely change your financial destiny. Now, let's bring this to your reality. Imagine you want to achieve financial freedom in 25 years. If your money grows at 10% per year, you can achieve more than 3 doubling cycles in that period. If it grows at 4%, you barely get one. The difference between 4% and 10% doesn't seem huge when you look at 1 year, but over decades, it's gigantic. And here's the most important part. The Rule of 72 reveals something even more powerful than seeking high returns. There's a factor that surpasses even the 10% rate, something no bank can sell, something no investment can recover after you lose it: time. Starting early is more powerful than starting big. Let me show you with a simple example. Maya starts investing at age 24. She sets aside $250 per month. She invests at an average of 10% per year and maintains that for 32 years. Nothing extreme, just consistency. When Maya turns 56, her investment is close to $600,000. Now, let's talk about Ethan. He starts later at age 34. He invests more per month, $450, same average return of 10% per year. But he invests for 22 years, not 32. The result? Approximately $360,000. Ethan put in more money monthly. Even so, he ended up with almost half of what Maya had. Why? Because Maya had something Ethan didn't: time. She went through more doubling cycles. Her money didn't just grow, it had time to grow on top of its own growth. That's the true power of compound interest. At first, it seems slow, almost invisible, but after a few years, the growth starts to accelerate on its own. It's like planting a tree. In the first few years, almost nothing happens, but after a decade, it already casts a shadow, and after 20 years, it becomes part of the landscape. Starting late means planting after other trees are already big. You can invest more money, you can accelerate contributions, but you never recover the lost years. Time is the only asset that cannot be bought later. And now comes the practical question. If time is so powerful, where does it work best? Where does your money actually grow fast enough to make a difference? Not all investments grow at the same rate. Let's compare using the rule of 72 itself. Account yielding 1% per year. 72 divided by 1 equals 72 years to double. Practically a lifetime. And that's before even considering inflation. Government bonds yielding 5%, 72 divided by 5 equals approximately 14 years to double. Better, but still slow. Now look at the historical long-term return of the S&P 500, about 10% per year. 72 divided by 10 equals just over 7 years. This means that money doubles approximately every 7 years. That's 10 times faster than that account yielding 1%. And the real estate market, historically something close to 8% per year, considering appreciation and income. 72 divided by 8 equals about 9 years to double. Do you see the difference? We're not talking about small details. We're talking about completely different trajectories. Historically, real estate has doubled approximately every 9 years when you consider appreciation and income. And there's another interesting factor, leverage. In the real estate market, your returns can grow not only on the money you invested, but also on the capital you financed. This can accelerate growth when used responsibly. Now, at the opposite end of the spectrum, there are highly volatile assets, cryptocurrencies, startups, highly speculative businesses. In recent years, Bitcoin, for example, has already shown extremely high annual returns in some periods. Theoretically, this could mean a very short doubling time. But here's the problem. High volatility means high instability. Most people can't stay invested long enough to capture those gains. They buy in euphoria, selling in fear, and end up not reaping the full potential. That's why experienced investors don't bet everything on the fastest engine. They build portfolios as if they were assembling a machine. A solid foundation for stability, a strong core for consistent growth, and a small portion for more aggressive opportunities. Because a fast doubling time only matters if you can stay invested. But even the best structured portfolio can fail if you ignore a crucial detail. The real enemy isn't just low returns, it's inflation silently adjusting your timeline. Many people believe that doubling your money means doubling your wealth, but that's only true on paper. If your investments yield 6% per year, but inflation is at 4%, your real gain is only 2%. This completely changes the scenario. By simple calculation, 6% would mean doubling in about 12 years. But with a real return of 2%, the doubling time approaches 36 years. Do you see the difference? The number seems positive, but purchasing power hardly moves. That's why looking only at nominal returns can be misleading. The numbers look positive, but taxes, fees, and inflation work silently in the background. And often, while you think you're moving forward, you're just holding your position. The real goal isn't just to double your money, it's to grow consistently above inflation. It's to make your wealth expand faster than the cost of living. This requires structure. It's not about choosing the fastest investment. It's about combining stability and growth. One part of the portfolio protects, another part accelerates. Some assets offer predictability, others offer expansion. Balance is what allows you to navigate market cycles without abandoning the plan, because a high return is useless if you can't stay invested long enough to enjoy it. Now comes the practical part. You can test your financial trajectory in less than a minute. No complex spreadsheets, No advanced formulas. Step 1, list your main assets, investments, real estate, businesses, any source that generates growth. Step 2, next to each one, write down the estimated average return. Be conservative, use realistic averages. Step 3, divide 72 by that number. This shows how long it takes to double. Step 4, now make the actual adjustment. If average inflation is 3% and your return is 7%, your real gain is approximately 4%. Use this number to apply the rule of 72 again. This is the doubling time that really matters. Now, compare it to your goals. If you want financial independence in 25 years, but your money only doubles every 30, there is a misalignment. This doesn't mean panic, it means adjustment. Maybe you need to increase contributions, reassess allocation, develop new income streams, reduce structural costs, but now you have clarity, and clarity eliminates illusion. Sometimes the fastest way is not to take more risk. It's to eliminate the small leaks that are delaying your growth. Because after you do this exercise once, something changes. You start to see time differently. Every financial decision starts to have weight. Every choice accelerates or delays your timeline. You start asking better questions. Does this decision bring me closer to freedom, or is it taking me further away from it? Does this investment really outperform inflation, or does it only look good on paper? When you start looking at your finances through this lens, you stop guessing and you start managing your future with clarity. The rule of 72 isn't just a calculation, it's a reminder. Wealth is built with time, consistency, and direction. Not with emotional bets, not with impulsive decisions. Real wealth grows silently. It doesn't appear in financed cars, it doesn't need external validation. It's built behind the scenes, fueled by small, repeated decisions every day. If you every day invest above inflation, avoid financial leaks, reinvest your earnings, maintain consistency, running out of money ceases to be a mathematical possibility. Not because you've become more motivated, but because you've built a system that works even when you're not thinking about it. So here's the challenge. Take your average rate of return. Divide 72 by it, then adjust for inflation. Now ask yourself, is this pace compatible with the life I want to live? If not, it's not a reason for despair. It's an invitation to adjust. Perhaps you need to improve your allocation. Perhaps develop new income streams. Maybe start today and not next year. Because in the end, the most valuable asset isn't money, it's time. And every year that passes without using it properly doesn't come back. If this video changed the way you see financial growth, leave a like and tell me in the comments, how long does it take for your money to double today? Thank you for watching.